All right, guys, what's going on, everyone? How's everyone doing? For some of you that I haven't talked to recently, I know it's past the cutoff deadline if you watch Curb, but Happy New Year. We're continuing up with our options playbook here. We've been going at this for some time, and I like this kind of process of maybe spreading it out a little bit and making sure everyone knows what they're doing. And a lot of you have contacted me with questions related to some of the option strategies you've been looking to trade. And it is a little more complicated than standard swing trading, so that's good. The agenda for today is to go over parabolics and continuation pullbacks. And then I'm going to hold one last office hours, not a full class, like lesson-based class. I want you guys to work on this stuff. If you have any questions related to what you've been doing, a new earnings season is coming. So a lot of the earnings stuff we talked about is in play right now. There's a lot of continuation patterns. There are parabolics in play right now. There are bands in play right now. Almost every swing setup we've talked about is in play right now. So really good time to be working on this and asking questions. And those of you guys who are in the class right now, I know a lot of you guys watch it on video. But if you're in the class right now, any questions related to what you've been working on up to this point, just post them in the chat right now, and then we'll do an open session next week as well. When we do that open session, I want to talk about a few things that don't really relate to the swing concepts we go over, because the basis of this class is taking our swing strategy. And most of you guys know me from the swing, either swing service or stocks and coffee, or you just have followed me on swing, and using the different option strategies. We know how to optimally use them with our swing strategies, so you can trade options around them. So that's been the focus of this. But I'm going to introduce you guys in the office hours to some other strategies, not necessarily related to swing, and that is taking advantage of time. We talked about the multiple ways you can use options. Using it in terms of trading our swing directionally, right? And then there's volatility, straddles, and strangles. And we didn't really go over too much butterflies and condors because I don't really like to use them. I prefer to use this strategy. I don't think there's as much profitability with butterflies and condors, but I will talk a little bit about that in the Zoom session next week, just to introduce you to some things that some people might have interest in. But there's another element of option strategy, which volatility, direction, and then there's time. When we've seen how time can impact us, right? When we're trading options, and that can be positive or negative. If we're net buyers, then it hurts us. For net sellers, then it helps us, right? We can actually play time like we play volatility. And I'll introduce you guys to that in our office hours next week. And that'll basically be the end of the class at this point. But it never ends. So in the sense that you guys who have been in this class can contact me anytime, any questions you guys have, just shoot me a message if you're working on this. If it's 2 months from now and you guys are working on this stuff, shoot me a message. But no questions here. So I guess everyone has had a good understanding of what we've gone over. So basically in the class so far, we went over pretty in depth the options basics, the stuff we need to know to trade options, right? The stuff behind the strategies. Then we went over some of the main swing concepts, essentially earnings, trading at highs, continuation patterns, parabolics, rubber bands, tops and bottoms, right? And now we're fitting our option strategies around that, and we're going to continue that today. We've basically gone over earnings, and we've gone over rubber band setup, and that can be applied to bottoms as well. When I say rubber bands, obviously it's more immediate with the rubber band, but bottom formations as well. The same concepts apply. Now, today we're going to talk about parabolics, which is essentially the opposite of a rubber band. Instead of really deep to the downside, we're talking about deep or parabolic to the upside. We're going to talk about how we can trade that. So it's essentially the opposite of what we did with the rubber bands. And then we're going to talk about our bread and butter of what we kind of do as swing traders. That's trading trends, right? So we're going to talk about continuation, trend pullback, and option strategy. I'm also going to introduce you guys to synthetic options. That's creating a strategy that essentially mimics your equity trade, like when you buy 100 shares, but doesn't have the advantages or disadvantages that some of these option strategies. Basically, it's only if you want leverage and nothing else with your options, with your option play. So essentially, essentially taking more advantage of your capital. And that's all you're doing. So we'll talk about that as well, related to the continuation plays. As usual, as we're going through this, if you have any questions, shoot me a message in the chat here and be active. If I ask you guys a question, try to answer it here as well. So let's start with the parabolics. Let me ask you a quick question right now. We've gone over swing, what a parabolic is. We haven't gone over the option strategy. So really quickly, let me see if you guys have been on top of the market. Name a stock or an industry right now that you would identify as being parabolic. And I shouldn't have had this up here. Yeah, there we go. Now you guys can't see. Oh, there, silver. Right, I had it listed right here, but I have a feeling you guys knew it already. Silver, very much so. And also a lot of the other metals as well. Recently, we had some retail stocks that had gone parabolic, but they got hit a little bit. Here's AEO, that had been trading right here at about 17 and ran up to 28. If we went from here, 14 to 28, which would be a 100% move. And a number of the ANF was another one. Here, you can see here, it broke out here at 68 and went all the way up to 130. So the 100% move. So this was parabolic, but then we got a gap down. So we can't use that right now. But you're right, silver. Now, we don't need to go over parabolics that in depth. We know the swing strategy. Our point here is now how do we trade it with options, right? So we know this is a parabolic. Let me just do a quick review. We can see here it's gone parabolic to the upside, right? Big, strong move to the upside. Very little consolidation, right? Maybe a little bit in here. Outside of that, it's basically been kind of a straight move up. And little consolidation is going to happen, but this is essentially kind of a straight move up here, right? And getting super parabolic now. We talked about the widening gap between price action and the 50-day moving average. We're getting that as well. Look how wide the gap is here. Stochastics being extremely overbought, and you can see here above 90. So all of those things we've talked about that qualify as a parabolic, we see that right now. The only thing we don't have is the trigger, right? Remember, we have these parameters of what we're looking for. Now we need the trigger, some kind of ugly kind of candlestick pattern that triggers us for the entry, and that we do not have right now. Or a breakdown below the 90 MA. One of those things. So we see that silver is parabolic. Kind of hand in hand in silver. Here's an aluminum stock, AA, which is a big liquid stock that we can also use options for very easily. And you can see very similar, not maybe a little less parabolic, but it's parabolic. You can see here, if we go from here, maybe there's some consolidation here, but we can see a move of 31 to 66 over 100% move. So definitely parabolic here as well. And we're watching for a potential now hard pullback here that we can profit from and go short, right? So we're looking for the we're looking for our swing parameters to be met. Let's go with silver here. And we see obviously those parameters are met for watching a parabolic stock. Strong stocks, I should say liquid stocks work best for options in this. We want to make sure they're liquid, and AA and silver both fit the bill. Deep run within trend, we're seeing that here. And identify stocks that are not character shifts, meaning the stocks have been in this very strong trend. And now the first time we get into it is when that character shift is going to be in play. So we have all of that right now. Now, to make this easy on us, let's say we have the trigger. Okay. We don't really have a trigger right now, but let's say we see this as a bearish pattern. So we want to go bearish on this, right? The way we would do it, if our standard trading is we decide how many shares we want. And let's use 100 share blocks to make it easy for our options. So we want to short 100 shares of silver. We would short it right here, SLV. Now, the ETFs can be a little tricky. They can be shorted, but sometimes some brokers are a little more hesitant to allow you to short them. So it depends on your broker and how many shares they have available as well. But it can be shorted if shares are available within your broker, and different brokers are different. But let's make that assumption that we can short it. 100 shares here, we'd be shorting at about 83,832. Let's just say 83. Yeah, that's where we want to short, right? We can see potential target ranges. One would be maybe where there's consolidation right here at 66. And these levels are going to be important when we're looking at what we want to target. So we'll say 65 here, or the 50-day moving average down here at 57, right? 57 or 65, somewhere in there, we'd be looking to target. And we don't want our stop somewhere above this range here let's say around 86 or so, maybe a little looser than that. So very good risk reward on our equity trade, right? Maybe we're risking 3 or 4 points, and if we went all the way down the 50-day moving average, we're looking at 67, 77, like 25 points on maybe 5 points of risk, let's say. So 5 to 1. So very good risk reward there. And even if we went down here to 65, which is probably more reasonable, 65, that's still going to be very good risk reward here, about 20 points on 5 points risk. So good risk reward here. Now the question is, we know these different things we can do with options, right? These bearish plays we can do. What should we do here? And I don't think there's a right or wrong answer to this. What you should be doing is looking at the different variables, the different ways to play it, and then deciding on which way you think is best for your trade. So one of the things we can do, remember, we don't like to be buyers generally, right? Because of that high break even. But when we have that rubber band, or in this case, parabolic, and it's so stretched out that we think there can be a very hard fall, in those situations, we can potentially just be buyers. Okay. With the rubber band setup, it was buyer of the call, right? With the parabolic, it would be the buyer of the put because we're going bearish now. We can pay attention to things like implied volatility. We obviously want to know that. Let me pull up Market Chameleon here. And we'll look at the implied volatility on silver right now. My guess would be it's going to be very high. We can see here 100%, which is obviously elevated. Well, 80 is the 80 is the IV, 30-day IV. The IV rank is 100, which obviously is very elevated, about as high as it can go, right? So that's something to think about if you're going to be a buyer. Premiums are expensive right now, and that's usually not where you want to be a buyer, right? So premiums are expensive. If we buy the put, it's going to cost us more than it normally would, and we are going to have a pretty high break even point. So that's something to think about. But let's just say now we think this thing can fall so hard that even though implied volatility is like this, maybe we're willing to still do it. And let's look at AA. And this is going to be a theme that happens when the stock has gone parabolic. It's really volatile, really in play. Everyone's usually trading it, and you're going to have high implied volatilities. And you can see with AA, same thing. 58.6, which is an 89% IV rank for AA, which again is elevated or very high. You can look at the historical chart here and notice where it is right now. It's on the higher end. You can see the lower end here, the higher end. It did have a huge spike here a while ago back in March, but still very, very elevated for where it normally is. You can see these are the lows, and we're at essentially the highest since March. So AA is elevated as well. But again, let's just say we want to buy a call, or we're looking at buying a call. Couple of things we can think about here. One, we can be buyers, but now how do we want to play it? Do we want to play it at the money, in the money, out of the money, deep out of the money? We're going to throw in the money out, okay? Because we have the expectation that this thing is going to drop like a rock. So I don't want to, I'm already paying higher premiums. Now I'm going to have to pay even more higher premiums to be in the money. Sure, I'll get a better win rate, but I feel like this thing can really drop. So I don't want to pay a lot. In the money is out. We could go at the money, and that's kind of the same thing, and be okay if you do at the money. But again, we're not taking advantage of our analysis of this stock. So the two things I will think about in this scenario, and we also want it to be cheap. And the more out of the money we get, the cheaper it gets, right? Because we want this play to be a very low risk, high reward play. In the sense that we're going against trend. This thing could go higher, and I don't want to be risking that much, right? And being more out of the money, in a sense, protects you because you're paying less, and that's the most you could lose. That gives you an automatic risk control, right? Than if you were paying more. So we're going to decide now between deep out of the money and slight out of the money. Okay. So let's say our deep out of the money put strike is significantly below price. We have no intrinsic value, right? Because our strike is below our price now. We need to move into intrinsic value, which is below our strike. So we need this thing to move very quickly below our, because of time. We want it to move very quickly below whatever strike we have set for that, right? And if it's deep out of the money, it has a lot to overcome to get to that strike level, which is normally hard to do. But remember, we have lower cost, and we expect that this thing has the huge potential for a big decline or a big percentage gain decline, right? So when I'm thinking deep out of the money, I'm usually starting my delta around zero point 0.3, maybe down to 0.2. Anything lower than that, and it gets really hard to win. It'll be super cheap, but really hard to win. You're really gambling at that point. Even 0.2, you're starting to really gamble on it. Okay, so that's the idea here. It's not a whole lot different than the rubber band setup, right? So let's take a look and think about our checklist. Let's do silver here. Think about a checklist. First of all, what is our implied volatility? Is it low? Obviously, the answer for silver is it's not. And your answer to most parabolics is it's not going to be. Now, the second question is, so we don't have a positive answer to our first question, but then the second question, if it's high, do I feel it can overcome the break even? Of course, we have to see where the break even is. But we know there's potential for this thing to drop to say 66, and it happened when it starts to pull back. It could happen very quickly, like it did here back in October. Right? We're seeing a more extended version of essentially what happened here in October. It's even more extreme now. So my question is probably going to be yes. We haven't calculated it, but we'll say yes. And then after that, we want to look at potential profitability and risk and how time is going to impact it. And then we're going to compare it to the slight out of the money call. And then you have to make a decision on which one you want to do. So let's go ahead and take a look at this. And let me first get, because it really doesn't tell us, I don't think, on option strat. But here, let's take a look at silver. And let's go about maybe around 45 days out. Remember, our sweet spot for most of our trades is somewhere between 30 and 60 days out. Let's say 43 days out. And actually, I'm going to go, we'll go 43 days out. Where it's trading at 83 right now. So here's 82.50, here's 83, here's 83.50. Make sure I got puts on. Okay, here are the puts. We can go 83 or 83.50 for at the money, and you can see where our delta is. Now we want to go more out of the money. So 0.3, I don't think I don't have it set enough. Hold on. Okay. So at 0.3 delta, we're looking at 76, right? So we're placing our strike right around 76, which is definitely doable for us. We could even go lower than that. You can see the price right now at the 0.3 delta is 480. Let's go even lower than that and go to 0.2. And at 0.2, we've got, let's say 2.1 here. We're at 71. So, and that's going to cost us 290. So we almost cut the price in half by going down to 71 here, right? And look at in the context of the chart. We definitely think we can get lower than that, right? We're targeting way down here. So we can probably go deep out of the money here. Make it in very cheaply. Now let's take a look at instead of calculating everything, let's just go to our option strat here, and we'll go to the long put. And we had used the date of February 27th. So here's the 27th. And at 83, we can see it would cost us 827 if we were going at the money. Right. Let's go down to 76, which was our what we were classifying as deep out of the money at 76. A little different price than what it was showing here. We were seeing, wait, what price did I set it at? 76. Oh no, that's right. Okay, 76. We would have went down to 72. Okay, so let's go down to 72 here. Okay. So you can see the profitability chart here. Now notice if the price goes up, we're going to start losing money, right? The most we can lose here is $315. You see our break evens, and notice how the longer it takes, the larger our break even becomes. And we are targeting with that target at the 50-day moving average, let's say at 57. If this thing were to go down to 57, let's say in a week, so well, let's just go to 26 in 10 days. If it went down to 57 in 10 days, we make $1,200. And we have plenty of time here all the way to the 27th. Even if it went to Feb 57 down at all the way to February 27th, we still make $1,185. So if that is our target and we're only risking $315, we have the potential here for $1,100 on $300 risk. So obviously very attractive here and this is deep out of the money. Now let's go to slightly out of the money. And let me write these down because we're going to do comparisons here. So deep out of the money by February 27th, we could potentially make about $1,180, I think it was. If it's about a week, which was January 20 something, we were going to make around 1,300, I think, a little the high 12s. And now let's do some comparisons. So now let's compare this with what we were classifying as slightly out of the money, which was actually probably higher than 76. Let's say 78. Now at 78, at that same target, um, let's see how much it costs us. Now it costs us more, 560 versus what was it before, around $300. And then now let's look at the profitability. It's costing us a little more, but now at that 57 target on the 26th, now instead of around $1,200, $1,300, we make almost 1,600, 1,560, right? And if we hold to expiration and hit that level, 1,540, right? And you can see if it were to go, we're not planning for a higher target, but that's about it. That's the potential. So now if we go slightly out of the money on the put, instead of the 1,350, we can make almost 1,600, right? And then to expiration around 1,500. So you can see the difference here, but pretty close. At this point, they're so close. Why not go deep out of the money, right? And pay less for almost the same amount of gain. All right. So these are the classic kind of just buy the put, right? And you can see the potential profitability here, how little risk you're taking. And even if you hold this thing to, let's say for 2, 3 weeks, and maybe it just goes up slightly to 84, 87, you're not losing that much, right? For your potential, the gain you could potentially make. So I think in this case, the standard, even though we have high implied volatility, this is definitely one where you could buy the put. But now let's also talk about using a spread. So we can buy the put, and we're willing to do that again because this is one of those stocks where one of those setups where we can make a lot, risking a little. And we have an expectation this could drop very hard, right? So we feel like we're overcoming some of the problems with being a buyer. So with the slight out of the money versus the deep out of the money, same strategic process overall, right? Right now, we're basically deciding: do we want to go deep or slight? How how is our how does this impact our profitability? How does it impact our risk, our position size, how much we're willing to put into it, and so on. So some strategy notes. Remember, the slight out of the money makes it more likely to win, and you get a little better break even, right? Well, sometimes a lot better break even. Thus, the better win rate. There's a better win rate than the deep out of the money. However, it will cost you more, and we saw that as we compared the two. In terms of what should we do, there's really no right or wrong answer. This is a personal preference. My default is if I'm trading one of these parabolics and I think there can be a really big move, why not go with deep out of the money? This is one of the few spots where, I talked about this before when we started, that being a buyer is definitely is usually a losing proposition, and going deep out of the money is definitely a losing proposition for most trade setups. But for this one, I actually like going deep out of the money, playing it cheap. Feels like a gamble trade, but it's when we strategically look at it, it's really not. Risking very little to gain a lot, and you're going to gain a lot plenty of times when this works out. Okay, so that is the two examples between going out of the money with the put or slight out of the money with the put. Any questions here? And I haven't seen any commentary here, so someone say something here just so I know we're not frozen and you guys are hearing everything properly. Now let's get to the bear call spread. Okay, good. Now, obviously, we know we are taking on a little more risk when we are a buyer. And we do have implied volatility, so premiums are higher than they normally would be. So we can also look at the potential for a bear call spread, especially when implied volatility is really high to make it a little bit cheaper for us, right? So we know the benefit of using, I wrote credit here, that should be debit. The benefit of using a uh, debit spread is even if the stock doesn't move off the reversal candle, I can still win, right? So we don't need that big move down with the bear call spread, right? So if we think, as we're looking at this, especially if we're maybe not taking the best setup, right? This is not the best formation, right? But we still think maybe it can drop. So maybe I don't want to be super aggressive and go with the uh, being a buyer because I think this has potential to languish here for a little bit or maybe go higher. Then I can do the bear call spread, which is going to cap my risk even better than just the buyer where it's the entire cost of it. I can cap it more, right? And if it just languishes, I can still be profiting, right? Remember with the call spread, you're reducing your break even. So even if it doesn't make that big move down, I can still profit. So if I'm kind of iffy on it, or I'm really concerned about implied volatility, and I don't think I can, I don't know how likely it is that we break the break even, then I can go with the bear call spread. And sometimes what I'll do, if I feel like taking a shot, I'll do the bear call spread. And when it's a very clear setup, then I'll go with the out of the money put. Um, so note again that when you use the bear put, you'll get a better break even and win rate, but you're capping your reward, right? And the point of this is to get the big reward. So in general, my preference is, and it's kind of backwards from the way we normally think, but for this setup, my preference is to be a buyer rather than doing the spread. But if I feel if I'm questioning it, if I feel like I'd like to take a shot, I'll do the bear call spread. Remember, the farther you make your spread out of the money, the more risk you take on, but the more profitability you get. So as you widen it, you're taking on more risk, but you're also increasing your profitability. The tighter it is and the closer it is to at the money, the more you're going to win, but you get less profit. So let's take a look at the potential for a spread on this. We'll use the same date, the 27th. And go with the bear call spread here. And we'll just do it the way they have it set up here at 86. So here, oh, I did both call spread, sorry. Let me get to bear call spread. Okay, there we go. We're actually lower, so let's widen this out here. Now notice here, in this scenario, now I'm going to put this here. There we go, at the money, and then there. Okay, now I can win a lot more. Okay, in this scenario, notice my max risk, the net debit of the spread is $700, which is actually in line with what's being buying the put, like at the money or slightly out of the money was. But look at how tight my risk is in here. The risk is very tight in this spot here. Most I can lose again is $700. And the way I've created it here with it wide, I could win close to the same amount, right? At that 57, at that 57, uh, I make 1,050. So not quite as much. I could play around with these and tighten my risk or increase it. But in this scenario, we could do a spread, but you can see by the profitability here, and that's what we should always look at is the profitability. It makes a lot more sense with this setup to be trading the uh, the out of the money put, whether it's slight or deep out of the money. Okay, regardless of strategy, know where your levels are in terms of like if you were trading it as a swing trade and base your strategy around those key levels. Separate, yeah, when you're a seller, there's always risk of assignment. Yeah, Devil, you can't remember that probability of profit is theoretical, right? We are saying we have an edge in beating that probability. Uncle Fish is asking, when the trade moves against you, how soon do you get out? Good question. So if we were looking at SLV, what I tend to do in a scenario like this is I treat it as my swing trade. I know the levels where I would get out if I was equity trading, but I'm willing to hold if it hits that level and I haven't hit the dollar amount that I'm willing to lose, right? So think about it in the sense of the way we look at our swings. So if I was looking at our swings, I have a max loss, 1% risk or whatever it is, right? So I would take my 1% risk wherever it is on this, that's my max loss, and I'll get out whether it's over here or over here. If I'm waiting and waiting and I'm only at, let's say my max risk was $400 and I'm sitting at 165, I would keep holding on. So there's not a time in terms of how soon. There's not a time level for that, but I have a dollar amount in my head, and wherever that hits, I will get out. And that dollar amount is based on my 1% risk, as I do with my swing trades. And then, of course, my target has to be more than that. And with um, just as we do with the parabolic setup with swing, I want to be able to get 4-1 or 5-1, not the standard 2-1. So I'd be looking at that 971, and this would have to be 3-1, 4-1, 5-1 on whatever I'm getting for the risk that I've identified, not necessarily the max risk that we see here. All right. So that's a parabolic. A little bit of a semi hedge you can do, which can be a little risky, but let's say we're looking at this stock, and sometimes it is helpful, like we were saying with the bear call spread, where we take the bear call spread because we're a little iffy on the setup. Now that does cut your potential profit down, right? Another way you can hedge is to buy the put and then also put on your bear call spread. Now, I call this a semi hedge because it's not a true hedge, because if it goes against you, now you're going to lose even more, right? But where it helps you is if the stock is quite kind of languishing range bound or has gone down not enough to beat your break even on your buy put, but it's gone down enough to profit from the bear call spread. So in that scenario, it's kind of a semi hedge. The only time I do this is kind of similar to what we see here with the bear call spread, and that is in a spot where I'm a little iffy on the setup itself. And I could be iffy for one of two reasons. One is I'm not seeing the reversal candle. Two is it's not as extended as I think it should be. So maybe if I was doing it down here, and which would have played out in back in October versus now here, it continued to go higher. So you can do this semi hedge as well, essentially putting both of these on at the same time. But remember, when you do that, make sure you stay within your risk, whatever your max loss would be, whether that's 1% of your trading account or however you're calculating your potential max loss, because it doesn't protect you if the stock goes up higher, only if you're range bound. It can act as a semi hedge. Charles, I mentioned before, we might, Charles is asking, should we use the bear call spread in this scenario where we have the high IV? Not necessarily. I would use the deep out of the money call. Sorry, the deep out of the money put here, because when we calculated this, we saw that where we're targeting, we can where we target. Sorry, what the level we are targeting easily is below the break even, and so even though it has a high implied volatility, if we're targeting here at around 57, we're still more profitable doing the deep out of the money than the bear call spread. All right. If there are not any more questions, let's take a look at some stocks that we could do this with. Obviously, there's silver, there's gold, essentially any of the gold miners right now. If you guys have any potential candidates, recently we had AEO and some of these retail stocks, apparel stores that were putting in these potential setups. Not now, but maybe they still could be done now if you're targeting, say, down here around 18. But I would think your target would be down here at about 23. So this wouldn't be the same setup now. All right. If there are no more questions, let's go to the next topic, which is continuation patterns. So continuation pattern that we're looking at right now is essentially the trend continuation pattern, any elements of that, and then the pullback to key support level. So essentially, this is trend pullback plays, right? So if we're thinking about our swing setup, and we're seeing this with a lot of stocks right now, we're looking at a stock that is in a trend continuation pattern, has pulled back to a key support level. We'll just default to the 50-day moving average right now. It could be 50-day moving average. It could be an old pivot range, an open gap, whatever it is. Pulled back to that level. When we normally trade it with our as equity traders, we would just get enter here, whatever it is, 100 shares, right? We'd probably target the top of the range. That's how we would be playing it. If we're really aggressive with it, we're not trading the top of the range. We're willing to hold a little longer, and we think it's going to break the trend and go higher. So that's essentially the setup we are talking about. Pullback, and then when our entry is the pullback play rather than the breakout. How do we trade that? We can buy a call. We can use one of the spreads, either the debit or the credit spread. And the other strategy we could use is potentially a synthetic long. We'll talk about that in a second here. So just like with the parabolics and the rubber bands, there's multiple ways we could trade it. The question is, which strategy do we use? For the buy call, our entry trigger is either anticipating a remount or confirmation at support. So, and that's essentially the entry trigger for all of these, right? And we just kind of drew it out here. And that was the pullback play. Let's say this is the 50-day moving average. We're either letting it pull back to the 50 and it shows strength there and we're entering here, or it has violated that level and we could either trade it on the remount, which essentially becomes this, or we can anticipate and enter here. And those of you who know me as a swing trader, I do this a lot, right? So now the question is, how do we trade that? We get our entry trigger. First thing we're going to do is look at our implied volatility. And in this setup, implied volatility becomes much more important than with the parabolic. Because with the parabolic, we expect a big move down. In terms of if you're thinking baseball, we're looking for the triple or the home trade when we're looking at these parabolics. With our standard trend plays, we're grinding out singles and doubles. We're not expecting that huge move in a short period of time, right? And it's very hard to predict that the stock is going to move very fast, very quickly in these trends. Sometimes they do, sometimes they don't. Sometimes, we could be holding it for 5 days. Sometimes we're holding it for 2 weeks, maybe even a month. And it's very hard to predict that. So we need implied volatility to be low to be a call buyer. So remember that with the trend play, we need implied. I wrote moderate and low here. We generally need it to be low here. We're going to be buyers at the money or slightly in the money, which again is very different than what we were talking about with our either our rubber bands or parabolics, right? Where we wanted to be either slightly out of the money or very out of the money. Here, we want to take advantage of at the money and in the money. So we're looking at zero point 0.5 and zero point 0.6 deltas. No longer are we looking at zero point 0.2 and zero point 0.3 deltas. Now, we're not going to go very in the money because that's going to cost a lot and we don't want to pay those premiums. So generally default to at the money, and maybe you can go slightly in the money as well. And then calculate your risk based on hitting your recent high. So basically, what I mean by that is we know where the high is, right? And that is going to be what we are targeting with these trades. Now, occasionally with the trend play, maybe you're willing to hold longer and you're not just playing to that old high, you're playing for the breakout. But your initial calculation for risk should be still based on this. And so I'm looking at this and I know if I can potentially gain, say, $600 here, my max risk is going to be $300 when I'm looking at the profitability of the potential trade. All right, so that is the buy call. So let's look at a stock that we might be interested in and that we could buy a call. If you guys have any examples, let me know. Let's take a look at Tesla here. And I picked Tesla not because it's the best setup, but because the implied volatility is low here. And notice here, if we look at, I like to look at implied volatility when I'm looking at whether it's low or high, two ways, right? The IV rank, and I also like to look at the chart because sometimes there is some discrepancy here. But if we look at here, 30-day IV is 47. If we look at the chart here, we see where implied volatility is right now, and it's pretty low, right? Just recently, it was up here around 60, 61 here, just about a month ago. And you can see how high it has been way back here. So implied volatility is pretty low right now. Now, remember this, we're talking right now about continuation pattern. Remember when we talked about earnings run up? Interesting that implied volatility is still pretty low now. And we have earnings coming up on Tesla on the 28th. So this might be a good candidate for earnings run up as well. So we're not going over that right now. But if you're looking at potential earnings run up plays, implied volatility is low on Tesla. It could increase as we get closer to earnings, right? Which would help you if you are a buyer. So we like Tesla here. Now, is it the best continuation pattern right now? Probably not. But it is a continuation pattern. We have a higher low still. We had a higher high here. It's still within the context of its trend, a little below the 50-day moving average. And the 50-day moving average is starting to curl over a little bit. So maybe that's a little concerning. But let's just say we like it as a continuation pattern right now. It's right at around the 50 average. Maybe we're anticipating it a little bit. So 438.57 right now. We're going to buy the call. Let's say, and let's forget about the fact that earnings are going to be in the way here. But let's say, again, we're going to the 27th. Oh, let's go to long call. Okay, and we can see here. Now notice here with the February 27th date, notice here, net debit, our position size is $2,700, which again is a lot cheaper than if we bought 100 shares at 38, right? Which would be about $40,000 to control 100 shares. Now we're controlling that for $2,700. So we're getting that leverage there. But here are the disadvantages. Look, as you hold this, let's say the stock didn't move, this dotted line here, look, you're losing more and more money every single day until the very end. If it stayed at this level, you're losing the full 2,700. And our break even at expiration is 467. That is way up here. So this is where we need to get to if we held to expiration, right? Remember that these break evens are calculated at expiration, but if it moves quicker, the break even is a lot lower, right? And it's continuing to get higher as we go farther out. But still, we have a kind of high break even, lower than it could be because implied volatility is low right now, right? So I'm not planning to hold this till the 27th, but let's say I'm willing to hold this. What's the date now? The 15th. Let's say, and forget about earnings right now. Let's say I was willing to hold this maybe till the 9th. And now I know instead of 2,700, my max loss here is only 989. And I could say to myself, if I'm down, no, sorry, not 989. If it was break even, it would be 989. The max loss is still 2,700 if it were to really dip, but I can get out of here at any point, right? So I could say to myself, my max loss is $900. If that hits here on the 23rd, I would be out if it's still at 425, but I could keep holding on. So that's what we're looking at with just buying the call. right? So let's just take some numbers down so we don't forget here. In this scenario, let's say we are targeting top of the range. Okay. So that is 490. So my expectation is I could hit 490 top of the range before before the stock expires, before the option expires. And that's definitely with the volatility of the stock, that's definitely doable. That could happen very quickly, right? So if I hit that 490 level, let's just say we'll say 494. It was 492. Let's say 494. And that happened by the 30th. We could make about $3,300, right? And then if it happened at expiration, we could make $2,600, right? So that $900 potential loss that I said actually makes sense with this stock when we think about what we're targeting as our potential gain, right? And of course, if it went further than that and we were willing to hold past this, it could make a lot more, right? If this thing were really run, went to 527 by expiration, we could make 6,000 on only $2,700 here. So, but with our standard continuation play, we're probably going to take profits here. So let's do that comparison. So now let's think about the bull call. So that's just buying the call, which because we are at low, um, because we are at low implied volatility, we could consider buying the call. But now let's compare that to the debit spread and the bull call spread. And the bull call debit spread is my bread and butter for most of these continuation patterns when I have a defined reward cap, because I usually do target the top of the range on these things. So this is essentially going to be our default unless there is very low implied volatility, or I think this is a really strong trend and some other factors are in play. Maybe we're in a strong market. Maybe this industry is really hot right now, like AI or something else. And I think we can break through and I'm willing to hold to a higher target. Then I won't do the bull call spread. And then I'll switch to the buy call, right? And maybe if I was thinking about Tesla, it does fit the bill for implied volatility. It doesn't for what I think the target should be, right? So I'd probably do a bull call spread. So let's do the comparison now. If I do the bull call spread, and we'll just say our target here is what we said before, 490. So here is the target at 490. Now notice here, in this scenario, we have capped our risk even more, right? Our max risk was $2,700. Now my max risk is $1,600. And each of these levels, if we look at it earlier on, are going to be less than what the buy call was. So we've helped our risk here and our risk control, and that $900 max loss will be more likely not to get hit than with the buy call. Here's the minus 900 at like 418. I think that was around here. If much earlier with the buy call, right? And that makes sense. Now let's look at the potential reward at 490 at expiration. I could make about $3,300, which is actually more than what I would have made with the buy call because time decay is not hitting me. Now that seems odd because you feel like you can make more with the buy call, and you can if it goes. I'm capped now at 3,300, right? Whereas if it keeps going higher and higher and higher with the buy call, I can make 5,000, 6,000, 7,000. But in the scenario where I'm targeting top of the range, this buy call, you can see why the bull call spread is a better options trade than the buy call, unless I'm targeting higher. Then I could go with the buy call, right? So that's the question you have to ask yourself in for this trade specifically. Do I want to cap it here, or do I want the potential for a bigger win, right? And I would use, for me, I would use the bull call here. But if I wanted the bigger win, buy call would be fine because implied volatility is low right now. These dynamics in price would be different if implied volatility was high. Then buy call probably wouldn't look attractive at all. But here it does if I'm going for the higher win. Now, so we can do the buy call. We can do the bull call spread, the debit spread. Now there's potential for credit spread as well, a bull put spread, which is a credit spread, right? We've been doing a lot of debit spreads. We could also do a credit spread here, and I would only go with the credit spread if A and B are not clear. Okay, and what I mean by that is let's say I'm looking at this and implied volatility is getting kind of high. So maybe buy call is not that attractive. And I'm looking at the trend. The trend is weakening. We're not in a strong market. I have concerns about the market as well. So now I think maybe this is not going to happen quickly. And I think there's a chance that we could be range bound for a while. If that's the case, I could do the bull put spread, knowing that if we just languish here, I can still profit, right? Now I'm capping my risk. I mean, I'm capping my reward even more, right? So we had the biggest reward here. If it goes higher, I've capped my reward here. But what's interesting is at the same level that we're targeting, I was actually going to make a little more with the bull call spread. Now with the bull put spread, my reward should go down even more, but my win rate will go higher because I have less of a break even. And a lot of the time the stock can even go down a little bit and I still will win. So if we look at the bull put spread in this scenario, here you see we had a break even to get over, right? Notice here, and I'm not messing with how they've created it right now, even though I probably should. We'll just keep it the way they have it. Just notice here, the stock could go down and I still make $325 here. And depending on how we create this, these numbers would change. But notice here, my potential profitability goes down quite a bit. I could change this by, I can increase the profitability by doing this. So let's just actually put it where it should be. So notice here, profitability, uh, there, profitability goes down, risk improves, and I messed this up actually. Risk improves, and we can profit from range bound action as well. So these are the three scenarios you need to be thinking about. Essentially, if you are very bullish, if we were to really break this down in simple terms, if you are very bullish, go with the buy call. If you have a level, you're bullish and you have a level that you're targeting and you don't want to go any higher than that, bull call spread. And if you have concerns about the market or the stock itself, the bull put spread. Now, if you have any questions, let me know here. One last thing is the synthetic long. Basically, what the synthetic long is going to do is you're trading it just like the equity, and you're getting none of the advantages of options, but also none of the disadvantages of options, right? It basically trades like you would be trading the stock. So what with the buy calls, with the actually you do get one advantage, which is leverage, but the rest of the disadvantages and advantages you don't get. It essentially becomes the same as trading the stock. So what we're going to do here is with the synthetic long is we're going to buy a call and sell a put at the same strike price at the money at the same expiration. What that's giving you is essentially a one total delta. Okay. So now your implied volatility and your theta impact is minimal. There might be little bits there that are a little different, but essentially very minimal. You're no longer worrying about implied volatility and theta, which essentially takes all of the option play out of it, right? When you're not factoring in implied volatility and theta anymore, your risk and reward are no longer capped. So your risk is not capped, your reward is not capped. You have max loss just like you do with your stock, right? Unless it goes to zero. But you can win as much as you would win. You can lose it. The higher it goes, you keep winning. The lower it goes, you keep losing. And you have to monitor your stops and everything just like you would with the stock. So let's look at the synthetic long here. So for Tesla here, and you can see how this is a straight line, no more break evens. Outside of the small net change in the premium, which is very minor here. So it's essentially a straight line. And then notice here, your profitability keeps going higher and keeps going lower here. But you got a lot of leverage here, right? Your net debit is $55. So you can trade it just like the stock, but no option strategy goes into it. You're basically trading your continuation pattern just like you would the equity, and you're gaining leverage. But again, none of the advantages and disadvantages and reward and risk and all those other things, taking advantage of time and so on with the synthetic long. And notice here, even though your net debit is $55, look how much you could lose here. Because so your risk is not capped. Even when you were a buyer, your risk was capped to what you paid, right? No cap risk, no risk capped here, capped here. All right, so that is the synthetic long. And those of you who don't want to get too involved with the option strategy, you can do that. But remember, you can lose just like you would with the stock, so you have to be vigilant with your stops. All right, so that's what I wanted to go with you guys today, guys. This is basically the basis of all the strategies we're covering here. Again, in our office hours next week, I'm going to do next Thursday, same time, and I'll send you guys the link via email later. I'm going to introduce you to a couple other things related to time, and I'll talk a little bit about butterflies and condors, but just a really quick introduction to that. And then it's going to be a Q&A. So what I would really like you guys to do is study this stuff. We're in a good period where just about everything we talked about is in play. There are rubber band setups, there's parabolics, we're in earnings season now. So all of the things we talked about, straddles, strangles related to stuff, the different credit spreads, debit spreads, buying and selling calls and puts. You can do almost anything right now. So work on this stuff. Any questions you have, we'll meet for office hours. And it's going to be more informal. This is all lesson based today. That's going to be just answering your questions and just a little introduction to some other topics related to options. All right, guys. If you don't have any questions, we'll see you guys next week. All right, talk soon.